Welcome to the second online lecture on Chapter 4, Tax on Commercial and Industrial Activity. In this lecture, we're going to study the fourth topic, which about the taxable revenue. So we have studied the first and the second and the third topic, and today, inshallah, we're going to explain the taxable revenue. And next lecture, inshallah, we're going to study profits from long-term contract and then deductible cost. And the two final topics will be losses carried forward for 5 years under specific rules, and finally tax exemptions. For the fourth topic, net tax profit is determined based on the net accounting profit disclosed in the income statement prepared under the Egyptian accounting standards and by applying the provision of tax law number 91 of 2005 and its executive regulation and their amendment. Article 22 of the law stipulated that the taxable commercial and industrial net profit is determined on the basis of gross profit after deducting all costs and expenses needed to realize such profits. From the preceding, it can be deduced that the overall tax profit is computed as follows. Net accounting profit from the income statement according to Egyptian accounting standard. This is the first item in the first section. Then we will add taxable revenues that have not been included and non-deductible costs that have been included. And then we going to deduct non-taxable revenues that have been included and deductible costs that have not been included to compute the tax profit or tax base. Revenue included in the tax base are determined based on a comprehensive concept of revenue resulting from all commercial and industrial operations realized in Egypt as well as revenues realized abroad if Egypt is a center of a commercial and industrial activity of the taxpayer. In this regard, Article 17 of the law stipulates that profits from commercial and industrial activity shall be determined based on the revenue resulting from all commercial and industrial operation. This includes profit from the sale of a company's assets as stipulated in items 1, 2, and 4 of Article 25. Profit realized from compensation received by a taxpayer because of depreciation or acquisition of any of such assets, as well as the liquidation proceeds realized during the tax period after allowing all deductible costs. The tax treatment of taxable revenues can be discussed as follows. The first type of revenue, it's revenue from a primary activity. It means that revenue generated from the main commercial and industrial activity for which the establishment was established. Such revenues are characterized by their periodicity and continuity, as they are derived from production and sales operation in industrial establishments and the purchase of and resale of goods in commercial establishment, respectively. The profitability model for the main activity varies according to the nature of the activity, but it's ultimately determined by the amount of net sales that exceeds their cost as follows. First, service establishment. It's determined by the difference between the revenue that these establishments earn from providing their services to others and the cost that they incur to provide these services. For commercial establishment, it's calculated by deducting the product's cost from the net sales value. Finally, for industrial establishment, it identified by difference between the net value of sales and its cost. However, the measurement of the cost of sales differentiates from commercial activity since both the value of production and the change in the value of inventory from finished goods are considered. There are a set of rules that the examiner must observe, which are as follows. For net sales, to verify the actual net sales, it's required to ensure that the sales figure reflects the actual sales that occurs during the fiscal year, and the same for the sales returns by considering the following. Applying the accrual principles or accrual basis, sales are recorded as soon as the sales has occurred, regardless of the collection of its value. Verifying that a portion of the actual sales has been omitted and that the sold goods have been delivered to customers. Withdrawal of the establishment owners, they are recorded at cost, meaning they are not included in sales. If this occurs, the difference between the selling price and the cost must be deducted from the net profit, except for liquidation cases. Ensure that sales returns are not overvalued due to the omission of the commercial discount previously granted to customer or the recording of fictitious or unreal returns. Consignment goods. These goods are sent at invoice price and are not recorded as sales unless sold. Otherwise, they must be included in the inventory at the end of the fiscal year. Goods sent to branches here, the distinction is made between internal branches. The goods sent to them are not considered part of the sales unless the branch sells them, and if this doesn't occur, they are considered part of the inventory. External branches, the goods delivered to them are included in the sales regardless of whether the branch sells them or not. Sale of production waste, it's deemed part of the sales and the resulting revenue is subject to tax. Part of goods of in-kind assets, these goods are recorded as sales and exchange must be made according to the market price or net fair value. If it generates a profit, it's subject to tax, but if it causes a loss, it's regarded as cost that must be deducted. Cost of sales. In commercial establishment, the cost of sales is computed by adding the value of net purchases minus returns of purchases to a change in inventory value. Thus, the cost of sales can be verified by the following. Net purchases. The examiner should consider the following factors. Following the accrual basis when recording these expenses. Purchase expenses don't include expenses associated with acquiring fixed assets or goods used by the establishment owner. Customs taxes are included in the purchase price when importing from abroad, considering import rules. In purchasing inventory in credit, the difference between the on-credit price and the cash price is recorded as interest expense and amortized over the repayment period. A change in inventory. The tax examiner must verify the accuracy of the cost of goods at the beginning of the period and its conformance with what was tax approved at the end of period inventory for the preceding period. It's also necessary to ascertain the authenticity of the inventory at the end of the period of the goods owned by the establishment that has not been disposed of until the date of preparing the financial statement by considering two significant elements: value and quantity or value. The second type of revenue, after discussing the revenue from primary activity, is capital gains from the sale of the establishment assets. They are incidental and non-recurring gains, such as those earned by the establishment from the sale of any of its fixed assets specified in Article 25 of the law, which include the following. Clause 1, building, establishment, ships, and aircrafts. Clause 2, purchased intangible assets, including goodwill. Clause 4, land, work of arts, monuments, jewelry, and other assets which by nature are not depreciable. Notably, the disposal may involve one of the previously specified or the entire establishment assets. In both cases, the realized capital gains are subject to taxation. Such profits are computed by comparing the net selling price to the asset's net book value after subtracting the tax-approved depreciation from the asset's historical cost. The third type of revenue or taxable revenue, profit realized from compensation. The taxpayer may receive compensation for depreciation or acquisition of any of such assets mentioned in Article 25, items 1, 2, and 4. If the compensation value exceeds the asset's net book value, the difference is taxable income or revenue. In the event of compensation, capital gains are determined in the same manner as in the case of the sales of fixed assets. Profit from the re-evaluation of the assets and liabilities of the establishment. In this regard, a distinction must be made between three cases that require a re-evaluation of the assets and liabilities of the establishment. Valuation relative to market prices, identifying the establishment's actual worth. The profit from that evaluation are only unrealized or estimated profits that are not subject to tax, since these profits didn't result in any real increase in the rights of the sole proprietorship owners. They are not subject to tax. Alerting or changing the establishment legal form, the profit from that evaluation are deemed realized profits and are liable to tax due to changing the ownership structure. This is when an establishment offers its net assets as in-kind share for joining or merging with another company. Valuation to provide the assets as in-kind share in the capital of a joint stock company. Profit from such evaluation are not subject to tax to encourage individual establishment to establish joint stock companies as Article 20 of the law stipulated. Tax shall not apply to profits from the re-evaluation of the assets of sole proprietorship when providing this is as in-kind share to the capital of a joint stock company, providing that the share corresponding to in-kind share are nominal and shall not be disposed of within 5 years. Realized liquidation proceeds. The tax applies to current and capital profits earned during the liquidation period. In this instance, it's indicated that if the liquidation period spans multiple tax periods, the liquidation proceeds are subject to tax during each tax period in which they are realized. Number 6, incidental or non-recurring revenue. The revenue generated by the establishment from operations fall beyond the scope of its primary business but are indirectly tied to its assets and properties. Examples include the following. Investment income, revenues from real estate and the farmland. It indicates revenue from renting real estate owned by the establishment to others. Such revenues are subject to tax as long as they result from built real estate or agricultural land included in the establishment assets, noting the deduction of tax on buildings or agricultural lands within the expense of the establishment under Clause 3 of Article 23 of the law to avoid double taxation. Dividends for shares and equity codes. Dividends for stocks and codes Dividends for shares and equity quotes. Dividends for stocks and quotes obtained by a natural person residing in Egypt from joint stock companies or partnerships, including companies established under the system of economic zones of a special nature, except for dividends distributed in the form of free shares, whether these distribution occur in Egypt or abroad, and regardless of how they occur. The tax rate on dividends realized from a source inside Egypt during the years received by a resident natural person shall be 10% without deducting any cost. This price shall be reduced to 5% if the shareholding percentage in the distributing company exceeds 25% of the capital or voting rights, provided that the period of possession of shares or quotes is not less than 2 years without deducting any costs. Grants and subsidies, such as production subsidies and export subsidies that the establishment receives from the government and local authority units to aid them in production, enable them to compete with foreign goods, or encourage them to provide their services. These grants and subsidies are included in the tax base based on the following. Cash grant or subsidy, it's subject to tax based on what was collected during the year. In-kind grants or subsidies, it's liable to tax based on assets, markets, or fair value when acquired by the establishment. Compensation and fines. They are the fund the establishment receives from other parties as compensation for incurred damages, and the following compensation categories can be distinguished. Compensation for losses from non-compliance with contract or delayed in implementation. It's known as the penalty clause in contract and is subject to taxation. The tax authority has determined that it constitutes revenue for the year it was collected. Compensation for losses or damage to a company's fixed assets. It's compensation for the losses of current assets such as merchandise. It's deemed revenue for the tax purposes and is liable to tax even if it was utilized to replace the damaged current assets. Collected bad debts. Collected bad debts. These are debts written off in a prior year or years and then collected in the following year. They are taxable if the tax authority approved them as deductible cost in the year they were written off. As the last paragraph of the Article 28 of the law clarified that if the debt or part of it is collected, the amount collected must be included in the firm revenue in the year in which the collection took place. Earned discount. This discount is considered revenue for the establishment which it receives from its creditor or suppliers if its debts or obligations are paid before maturity. Therefore, discount must be included as revenue in the income statements and it is thus taxable revenue. Number 6, foreign currency differences. A distinction must be made between foreign currency differences from foreign currency transactions. These are the differences that result from payment or collection occurring after transaction date. If such differences are credited, they are regarded as taxable revenues, but if they are debited, they are considered deductible costs. Foreign currency differences from translation of the financial statement prepared in a foreign currency. They are considered unrealized differences and are not included in the tax, profit, revenue, or expenses. Number 7, credit sales commission. It refers to the commission obtained for distributing items to other businesses. It's considered among the taxable revenues, provided that it relates to sales achieved during the tax year subject to taxation. Credit returns. It includes the returns obtained by the entity as a result of practicing its commercial and industrial activity, such as the receipts of the sales by installment or the returns of delay on the debts expected. Number 8, credit returns. It includes the returns obtained by the entity as a result of practicing its commercial and industrial activity, such as the proceeds of sale by the installment or returns of delay on debts of customers who are late in paying their debts due to the enterprise, or the interest of loans and advances granted by the enterprise. These returns are fully subject to tax. On the other hand, there are credit returns unrelated to the company's activities, such as investing a portion of the company's funds in purchasing bonds issued by the Minister of Finance in favor of the central bank or other banks. The return of these bonds are subject to tax under Article 58 of the law, which stipulates that, subject to any tax exemptions stipulated in other laws, revenues on bonds issued by the Minister of Finance in the favor of the central bank or other banks are subject to tax at the rate of 32% without deducting any costs. Profit from selling securities. They are the capital gains realized from the sole proprietorship investment of its excess fund in purchasing securities such as stock, bonds, investment in instrument, and financing instrument. These profits are subject to tax as follows. The value of taxable profit is equal to the sale or exchange price or any form of disposal of securities minus the acquisition cost after deducting the brokerage commission. The tax rate applicable to such taxable capital gains is computed as follows. Capital gains realized in Egypt. It is subject to a 10% tax rate under two conditions. The taxpayer must be a natural person residing in Egypt, and the securities must be listed on the stock exchange. It's liable to the progressive price of a taxpayer is a natural person residing in Egypt, and the securities are not listed on the stock exchange. To prevent double taxation, the tax paid on capital gains of securities, whether listed or unlisted, is deducted from the tax payable by the taxpayer within the limits of such gains. Capital gains realized abroad, it's liable to tax at a progressive rate if the taxpayer resides in Egypt. To prevent double taxation, the foreign tax paid abroad on these capital gains shall be subtracted from the Egyptian tax owed by the taxpayer within the limitation of these profits.